Hi guys, welcome. Netflix has just released its latest quarterly reports for Q1 of 2021 this week. Revenue is up 24% from the previous year, and the net income has hit a record of $1.7 billion. In this video on Netflix stock analysis, I'm going to dive into the financials and the technical charts to see whether is Netflix worth investing in, is it a buy or a sell at the current price, and whether Netflix is trending up or down from the technical charts. So let's jump into it. The revenue has been on a solid growth since 2017 from $2.6 billion to $7.2 billion in the most recent quarter, and there are no signs of slowing. The year-over-year revenue growth is averaging around 25%. Netflix is definitely growing at a rapid pace. The cost of revenue has also been growing in tandem with the revenue growth, but notice that the last quarter's cost of revenue has dipped downward. This is due to the reduced film production under the COVID situation. The result of continued revenue growth and reduced cost is an increase in gross profit. There is a clear jump in gross profit from the previous quarter's $2.5 billion to $3.3 billion. The gross margin has been strong with an average of 38%, with the smallest margin recorded at 26% in 2018. Netflix has been profitable and the profits are growing at a higher pace than the revenue. This is a good sign for Netflix. The net income is also in line with the operating income. The increase in profitability is evident in the net margin that is seeing steady growth from the low of 2.36 in 2017 to the record high of 23% in the most recent quarter. Although the record profits in the most recent quarter were contributed partly due to the lower cost in production as stated earlier. The trailing earnings per share of the last 4 quarters is a solid 8.26 and is following the same pattern of rapid rise that we have seen in the net income. Netflix has finally started to turn in positive cash flow from operations, but it is still not consistent yet. The operating cash flow was negative in the previous quarter. The trailing free cash flow for the last 3 quarters has turned positive. Free cash flow is operating income minus the investment in property, plants, and equipment. It is an indication of the real earned income after investing in continued operations in the business. This might be the turning point for Netflix from a startup that has been burning cash to finally becoming a profitable and rapidly growing entity. The net effect of all the cash inflow has strengthened Netflix's cash position. The cash and equivalents have increased from $1.5 billion in Q1 of 2017 to $8.4 billion in the most recent quarter. The position of cash holdings is evident in the quick ratio that has been growing steadily and is sitting at a healthy 1. Overall, Netflix's balance sheet is steady, with the total assets having grown from $14 billion to $40 billion. The total liabilities have increased too, from $8.3 billion to $30.9 billion. Netflix has a debt of around $21 billion. The current debt level is 52% of total assets, so it is on the high side. The interest expenses were in the range of 25% to 36% in the most recent quarters, but the recent jump in profits has reduced this percentage to just 11%. If Netflix can maintain the profit growth in the coming quarters and start to pay off its debt, it would solidify the balance sheet. The book value per share has been rising steadily and is at 20.77. The book value measures the net asset value, which is total assets minus the total liabilities on a per share basis. At the current price of $505, Netflix is trading at a multiple of 25 times price to book. That is a very high valuation. Usually, value investors look for a multiple of below 5. Although the year-over-year revenue has been growing in recent times at an average of around 25%, the PE to growth ratio is still on a high side at 2.6. The PEG ratio measures the PE in terms of revenue growth from the same quarter the previous year. It is used to value the stock price based on revenue growth. While Netflix revenue and profitability has been growing at a rapid pace, the stock price has risen at an even higher rate, pushing Netflix into the overvalued region. Let's take a look at the technical analysis. The longer-term trend is still on the way up, and the price has appreciated at a rapid pace since 2017. Taking a closer look at the daily chart, the recent price activity has formed strong support at 450 and there is overhead resistance at 560. The price has been trending sideways since July of 2020 between these two levels. In the most recent price action from the resistance of 560, Netflix has now settled at $500 mark. The market seems to be undecided about which way to go right now. The key levels to watch are the 560 and 450. So, is Netflix worth investing in? It is a profitable technology stock and is growing rapidly with many more years of potential growth. Is it worth it at current prices? The valuation of 25 price to book is way too high and the PEG ratio is above 1, making it an overvalued stock. Technically, while the overall trend is up, the price is consolidating. At these price levels, it is purely a speculative counter. AMD will be announcing their results this week, and I'll be doing a similar video for AMD. And I will also be doing a side-by-side comparison of AMD and Intel, similar to the one I did for the 5G stocks. Subscribe to my channel if you have found this sharing useful, and hit that notification bell so that you don't miss out on any of my future videos. And I'll see you soon in the AMD video.